In this session, I'm going to talk about the interest rates, which are one of the core elements when I have to look at valuation of derivatives, finding the real worth of any derivative instrument, or for that matter, any financial instrument. If at all I have to talk about the true value, the inherent value of any of the financial instruments, in particularly derivatives also, we look at interest rates as one of the significant stuff. So we really need to understand the different kinds of definitions that are associated with the interest rates, different kinds of measurements that are associated, and how I typically analyze the interest rates. So all these things and the different dimensions with respect to the interest rates, how I use them as a part of the valuations process, all these things is what we are going to look at as a part of this session. So let's get started off. Now, the first thing we need to understand in this context is the different types of interest rates which are generally used for the valuation purposes. The different types of interest rates. Broadly, I see to start with, we work with three different kinds of interest rates. One is the treasury rate, then we talk about LIBOR, and then we talk about repo rate, though there are so many others. Initially, I would like to touch base upon these three kind of rates. But before I even get started into that aspect, when I simply ask you what is an interest rate, we simply talk about two major roles, a borrower and a lender. That particular rate which a borrower will pay additional on the borrowed amount from the lender, that particular rate which the borrower promises to pay to the lender, that is what we call as the interest rate. Let's say the lender has lent $1,000 to the borrower. At the end of 1 year, the borrower pays 105, means the additional 5 that the borrower has paid to the lender is what we are calling as the interest, and this 5 is paid over a 100 that has been borrowed. So I convert it into percentage, it works out as the interest rate for that particular period. Now what we typically see is the interest rate number is different in different contexts. Probably when I am talking about depositing my money in a bank, the interest rate would be different. If I am taking a housing loan, the interest rate could be different. If I am taking a personal loan, the interest rate could be different, because all these interest, the definition is still the same. There is a borrowing and a lending in the process, and that particular additional amount which the borrower is agreeing to pay to the lender for taking the capital, for taking the loan from the lender. But the interest rates are different in each of these cases because of difference in the credit risk that is involved. When I say the credit risk here, we are talking about the possibility that the borrower may default, may not pay the interest and principal on time. So if the possibility of default is higher, then the credit risk is higher. Possibility of default is going to be higher, then we say credit risk is higher, then in that case the interest rate will be much higher, because the lender is taking a higher risk by lending the money, because there is a good chance that he will not get his money back. So what he typically is doing is he is trying to he is trying to increase his expected return. The higher the risk, the higher should be the expected return. So he is trying to increase the expected return, and which is why he is entering into a higher interest rate. So the higher the credit risk, the higher would be the interest rate promised by the borrower to the lender. And that is how the interest rate numbers differ from transaction to transaction. A pure analysis of credit risk, the possibilities of defaults will give rise to what kind of interest rate should be applicable. Now, the first kind of the interest rates which we need to be comfortable with is the treasury rate. Generally, it is the borrowing done by the government. So government borrows on a short term for 3 months, 6 months, 1 year by issuing what is called as treasury bills, or sometimes it could borrow in the long term for longer periods by issuing what are called as treasury bonds. Now, this is the way the government borrows from the general public and investors. So investors lend money to the government. Investors lend money to the government either in a short term or in the long term and in the domestic currency itself. So this does not take foreign currency itself. And we are all aware of this. The government, it's very rare that it will default. Right? Any borrowing done by the government generally is considered as highly secure. Very rare that the government is going to default in any case, and that too in its own currency. So that's the reason we use an alternative word for the government rates called as risk-free rate. We see at a lot of places we would be using this concept of risk-free rate, sometimes denoted as RF. For all the valuation purposes, we will be using this concept of risk-free rate, which is nothing but the rate that is associated with the government's borrowings, with the investment. From an investor perspective, they are called as investment in government securities like treasury bills or treasury bonds. And from a government perspective, it has raised the loan in the short term or the long term by issuing these kind of securities. So, especially for the valuation purposes at a later point, we'll see that there is a possibility that we use risk-free rate for evaluating many securities. But what we are seeing in the practical world is various traders, they believe using LIBOR more compared to the risk-free rate for the valuation. What they typically say is this risk-free rate typically, which is the treasury rates, they tend to be very much low in a practical scenario because of various tax and regulatory issues. So they are not a real reflection of the market. So they don't really reflect the market rate. They are artificially low because of various tax and regulatory reason, and that is where they try to use LIBOR as something that is for evaluating the derivative securities. Typically stands for London Interbank Offered Rate. Now the sentence itself is clear, the acronym is clear. London Interbank Offered Rate. So this is the rate at which one bank is prepared to deposit its money, generally large sum of money, with other banks. So this is the rate. So what is the kind of interest rate which a bank is expecting if it really wants to deposit its money with the other banks? So it's a kind of a borrowing rate So from the other bank's perspective, it is trying to borrow from this bank. So this is also a kind of a borrowing rate, but not by the government here. The borrowing is generally done by the banks here. And the bank which is depositing is actually the lender bank. So the lender bank will actually quote what is the kind of interest rates it is expecting if it wants to deposit for 6 months, 3 months, 12 months, any different kinds of periods up to 1 year, even 1 month, different periods up to 1 year kind of stuff. So these are called as LIBOR quotes. So typically it is seen that compared to a treasury, the banks, the default rate is slightly higher because it's not government, it's a bank which is a commercial setup. The default rates are slightly higher. Generally we see that they are having a credit rating of AA, whereas when we look at the treasury, you can look at it almost as a AAA kind of a credit rating, which means the default levels are almost zero. But yeah, even in this case, the credit risk is much lesser, slightly more than the treasury rate. So what we see is the LIBOR rates are slightly higher than the treasury rates, but from a true realistic perspective, they are much more realistic kind of rates compared to the treasury rate. So that's the reason for valuation of various derivative securities. We see that LIBOR is being used compared to a treasury rate. And all these LIBOR is typically traded in in the euro currency market. And this is one more reason why people tend to use it. It is traded in the euro currency market and no government has any kind of a hold on it. It's not regulated by any government, whereas here it's a government's kind of a borrowing mechanism. So even from that dimension, we see that LIBOR has a lot of importance compared to a treasury rate in terms of valuation. And what we see is if more borrowing of the US, let's say borrowing of a currency is happening, so everything, the rates are market determined. If the borrowings of a particular currency are more and the lendings are lesser comparatively, borrowings of a particular currency, borrowing of a US dollar is more than the lending of the US dollars, then what we see is the LIBOR will increase. Right, borrowing of a currency is more compared to the lending, then we see that the LIBOR for that particular currency is going to increase, otherwise it's going to decrease. So that is one more important interest rate that we typically look at, the LIBOR. And in some cases, the other dimension of the interest rate is also called as a repo rate. In detail, it is called as a repurchase agreement rate. See, generally what we see is a party which is owning some kind of investment securities. It is lending, it is selling these securities to a third party, getting cash, and after some time it is getting the securities back and paying cash and getting a securities back. Now what we see in this transaction is the cash which it has received here is lesser than the cash which it has to pay to get back the same securities. And that additional payment that it is making for its own securities is what is the interest rate that is involved in this process, and that interest rate is called as the repo rate. So it's as good as this particular party A has provided a loan to this company for a short period by taking the securities of this company as a collateral, and once this party pays back the cash with a higher interest rate, the securities are returned back. Here, for both the parties, there is it can be structured in such a way that it's a win-win for both the parties. Basically, if we are seeing this party has got the cash, right? In case it does not pay back the cash on time, this party can keep the securities and it can sell off the security. In case this party is not returning the securities, this party can keep the cash with it. So, this kind of a transaction where the securities are sold off to some other party in return for cash and with an intention that these securities will be bought back at a later point at slightly higher rate of interest. And in most of the cases, we see this kind of transaction, they carry a very little credit risk because even the time period of borrowing is very small. On the worst case, we even see overnight repos. So borrowing done only for one single day. But in some cases, it can go for a slightly longer period, and that's the reason we call as term repos, which are like three borrowings done for a 3 to 1 month, 15 days, 3 months kind of a purpose. So traditionally, we see that at a higher level, either a treasury rate could be there, LIBOR rate could be there, repo rate could be there. These are the different kinds of definitions that could be associated with the interest rates. But what we really need to know is when someone has quoted, let's say you go to a bank and you do a deposit with the bank, right? You go to a bank and you do a deposit with the bank, and the bank said 10% per annum is the interest rate. Now, it will always say 10% per annum. But how much you get after 1 year depends on what is the compounding frequency. The quotation always is 10% per annum, which looks quite straightforward for us. So, if at all I have to know what is the exact amount I am going to receive for a 1 year investment, then I have to understand the compounding frequency, which means the actual mechanism in which the interest rate is measured. Is it measured on a semi-annual basis? Is it measured on a quarterly basis? Or what is the precise method in which it is measured? So the compounding frequency will change, will determine how much are we really going to get. So it's as good as saying if it is 10% per annum compounded annually, then probably if you have deposited 100 now, at the end of 1 year you are going to get 110. But if it is compounded semi-annually, then it is like if you have deposited 100 now, it is going to give you 100 into 1 plus 10% per annum, but the compounding is happening semi-annual. So I'll take the semi-annual interest rate here, 5 by 100, and there are two semi-annuals in 1 year. So it is actually going to give you 110.25. Similarly, if the compounding is happening quarterly basis, the same 100 which you have deposited, it will become 100 times 1 plus 2.5% per quarter, and there are 4 quarters in a year, so it is going to become 110.38. Similarly, when you are going with a weekly kind of compounding, the same 100 of yours, 100 into 1 plus whatever the 10%, 10 divided by 52 is the interest rate per week, divided by 100, and there are 52 such weeks. So this is going to give you 110.51. Like that, what you see is as the compounding frequency is changing, the amount which you are going to get at the end of 1 year is changing. In general, if your compounding frequency is m times a year, what we simply say is, if your amount is, if you have deposited 100 now, it becomes 1 plus R by M. If R is already in percentage, R percentage by M to the power of Mn. At the end of n years, if you want, there are m frequencies, m times in a year and n years, so totally it is becoming mn. So this is what, so probably you can generalize it as, if you have deposited some a now, and the annual quoted interest is r percent, compounded m times in a year, at the end of n years you are going to receive an amount which is equivalent to this. So this is what will be the calculation associated with the compounding frequency. But one thing you have to understand here is, in all these situations, the quoted rate, the quoted, the quoted rate is always per annum, 10% per annum. What you are going to get could be more than that, depending on how the compounding is typically happening, right? And what is that you are typically getting is what we call as, so here in this case, if I am getting 110.25, means I am getting 10.25 extra over 100. So 10.25% here is actually called as effective annual rate of return. This is called as a quoted annual rate, and this is called as effective annual rate. In this case, 10.51% is called as effective annual rate of return. So that's one more term that you need to be comfortable with. And now in the same, whatever we are talking of, the amount which you have deposited multiplied by 1 plus R is in percentage terms, by M to the power Mn. This is what is the amount that you are going to receive after n periods. Now assume that M is almost infinite, means the compounding frequency is a very high frequency compounding. Very high frequency compounding, which is more and more which is more and more regular intervals, not even daily, hourly, minutely kind of a compounding is happening, then we treat compounding frequency as infinite. For very number of compounding, number of times the compounding frequency is quite closer, means number of times the compounding is happening is very high. This is where I target m tending to infinite. Then generally what we get is 1 plus r by infinite to the power m infinite. Using the uh, using the concept of limits, the same thing will come out as a into e to the power of rm, sorry, rn, n periods, a into e to the power of rn. So r is the quoted rate. R is the quoted rate in annual terms, and N is the number of years. I take it as e to the power of Rn, especially if my question goes with respect to compounding on a continuous basis. So whenever we are having daily compounding, generally we can treat it more and more similar to continuous compounding. What we generally observe is, wherever we are talking about daily compounding kind of a scenario, for majority of the derivative transactions, we go ahead doing the valuations as a continuous compounding exercise itself. So if I want to find out the future value given the present value, I multiply that amount by e to the power of Rn. From the future value, I want the present value, I multiply it with e to the power of minus Rn. And we can even convert from one form to the other also. Probably if you are seeing the same amount A, if I am looking at with a continuous compounding for n periods, if this is the amount, let's say I am going with some compounding frequency for n periods. These are what are the numbers. So probably I can take these things out. E to the power RCN is equal to 1 plus Rm by m to the power mn. So n I can take out e to the power of Rc. So I'll take it to the power m. So from here I can say Rc equal to log 1 plus Rm by m to the power m, which is I can pull out the m before m log 1 plus Rm by m, that is equal to Rc. So from here I can very well find out if I want to know the Rm, which is the annual quoted rate. I can very well equate it now. Rc by m equal to log 1 plus Rm by m. I can do the basic mathematics. So 1 plus Rm by m becomes e to the power of Rc by m, and so from here it becomes Rm equal to m times e to the power of Rc by m minus 1. So some such kind of a basic arithmetic can very well be worked out to convert the interest rates from one form to the other, from the compounding form to a discrete form of computations. All right. Now let's try to understand the other important definition of interest rates, which is what we call as the zero rates. Sometimes people call it as any year spot rate, or they also call it as any year zero coupon bond rate. It is nothing but if I have invested something today, if I have deposited something today, and I am getting some amount at the end of n years and no payment coming up intermediately, whatever is the interest rate that is getting applicable, whatever is the annual interest rate that is getting applicable in this particular process, that is what we call as the n-year zero coupon bond rate. So that is where we talk about whatever is the interest rate that needs to be paid on a loan which is starting today and it is lasting for n years. From a lender's perspective, whatever is the interest rate that is going to earn on an investment that is making, which will be lasting for n years, and no intermediate payments in between. So for those kind of instruments or securities where the payments happen literally at the end of the period and nothing intermediary, the annual interest rate is nothing but can directly be found out, which is equivalent to the zero rate itself. But majority of the instruments that are available in the market, majority of the bonds that are available in the market, they pay some kind of inter they pay some kind of intermediate payments. They don't operate like this, that once you have invested everything is paid only here and nothing after 1 year, 2 years. No annual or semi-annual kind of payment. No intermediate payment. Then the zero coupon bond is a perfect application. But in majority of the instruments case, we see there are lots and lots of intermediate payments coming into picture. So that intermediate payments are what we call as coupons. In general, we see that the coupons are paid either on an annual basis or semi-annual basis. Then it's very much important for us to find out what is the interest rate associated with that particular bond. If it is a one time payment, the interest rate, probably I have deposited 100, now I am getting 120 at the end of 3 years, right? Probably I have deposited 100 today and I am getting 120 at the end of 3 years. So how do I note that 100 today, it has become 120 after 3 years. So the easier way of it is writing 120 equal to 100 into e to the power of Rn 3. So e power 3r equal to 120 by 100. So I can write e to the power of 3r, that is working out to 120 divided by 100. And from here I can say 3r is equal to log 101.2. And from here I can say my r is going to be this divided by 3. So I can say that the interest rate in this process is going to be somewhere around 6.08%. But in majority of the cases, as we are saying, there will be some kind of intermediate payments in the form of coupons coming up. So if at all I have to find out the interest rate, the interest rate associated with the bond, we really need to evaluate a series of payments. So some are coupons, and finally there is a principal which is also called as par value, or in some cases it's also called as face value. This is generally paid at the end of the period, whereas the coupons are paid on an intermediate basis. So especially if at all I want to find out the theoretical price of the bond, we generally take it as the present value of future cash flows, right? So here comes the problem. When I am talking about the present value of the future cash flows, what is the discounting rate that I have to use to compute the present value? In some cases, people use one single discount rate for all cash flows. This is one mechanism, which is quite easy to execute but may not reflect the reality better. Whereas the other kind of mechanism says uses different discount rate for different cash flows of different periods. And those different discount rates for each of the years are nothing but the different zero coupon bond rates for each of the period. Now, we can very well take one example. I'll take one example so that things become easier for you. One side, let's say I'm talking about uh, a 3.5%, right? Let me take the example of a 3.5% annual coupon bond with a 5 year maturity period, right? A 5 year maturity period associated with it. So what could be the cash flows that are associated with the bond? At I can very well talk about the year number 1, 2, 3, 4, 5 different cash flows coming at the end of each of the 5 years. The coupons that are going to come, because it's a 3.5%, if the face value is 100, the coupon amounts are going to be 3.5 in each of the years. And when we are talking about the principal or the par value, which is 100, will come only in the 5th year. And so from this, if I want to look at the total cash flows, which at the end of each of the year, it's the coupon value plus the par value. So 3.5 is going to come at the end of the first year, 3.5 at the end of second, third, fourth and fifth. Now, if I want to find out the present value of all these cash flows, talking about the theoretical price of this bond, right? There are two ways. One, I use one single discount rate. Let's say for this entire period, the discount rate is 3.5%. I want to use 3.5% to discount all these cash flows. One single discount rate. So I want to discount all these cash flows, or probably I want to use a slightly different rate. Let's say I want to discount all these cash flows at 3.7%, right? I'll take 3.7% to discount all these cash flows. So the present value, if I'm saying for this cash flow, I'll discount this by e to the power of 3.7% multiplied by 1. Okay, this is the present value. Similarly, I can do this also. I can do it as 3.5 divided by e to the power of 3.7% multiplied by 2 and so on, right? Now these are the different present values. So the total present value is coming out as the summation of all these things, which is saying 98.79. So according to me, if I am using 3.7% as the discounting factor, then the present value of all these future cash flows, let's say, is coming out to 98.79, which means as per my calculation, the theoretical price of the bond should be 98.79. If it is more than that, if in the market it is available for more than that, I may not buy it, or I may prefer to sell it if I own it. Otherwise, if it is lesser than that, I will try to buy it. But the price of the bond should be somewhere around 98.79 for this kind of a bond. But on the other side, if I know the zero coupon bond rates, we'll see slightly later where do I get them from. But if I know the zero rates or the spot rates, right, I'm assuming some numbers for time being. If I assume that 2% is a 1 year spot rate, then 3% is a 2 year spot rate, 3.7% is a 3 year, 4.2% is for 4 years, and 4.5% is for 5 years. Now, if I am discounting using these rates, so which means this particular cash flow, I am discounting it by this particular rate multiplied by this year. So in this case, I am getting a different present values and probably the different summation altogether. The theoretical price that is coming through this mechanism, it is saying that the price of the bond is only 95.46. So this is the kind of present value that we are trying to compute. Theoretical price we are going to compute using a different discounting rate for each of the years, and that is where the discounting rate that we are using is the different spot rates that are corresponding to each of the years. So the price of the bond, the value of the bond, I can find out using one single interest rate for each of the periods, or I can have a different zero rate for each of the periods. Now, if at all I want to bring the price of the bond equal to the same, now what should be the discount rate I should have used? instead of 3.7%, let's say I have used 4%, right? Let's say instead of 3.7 across, let's say I have used 4%. Let's see what is happening. This has come to 97.41. Still it is lesser. Let's say I have used 4.5% across. If I am using 4.5, then it is slightly falling. So let me assume 4.45. If I am using 4.45, I am almost approaching, or 4.42. If I am using 4.42, I have almost crossed it again. So 4.43, if I am using, assuming I should be closing, yeah, 4.95.48, 4.435 if I go with, yes, almost met. So which means if I had taken the zero coupon bond rate as 4.435%, or probably if I had taken 4.435% as the number, as the interest rate for this entire period, if I had to use the one single interest rate for this entire period, then I should have used 4.435%. In that case, the present value, if I had computed using that one single discount rate, as well as the present value I have got using the spot rates, both of them are leading to the same. That is where I am able to arrive at the arbitrage free value of the bond. Why do I say arbitrage free? Some people discount it at this rate, some people discount it at this rate, giving them two different numbers. Then some people who feel that it is underpriced can get into a selling, the other price buying. Someone who feel it is overpriced, they get into a selling transaction. So buyings and sellings do keep happening just because of the change in the process. Whatever is the process I am using to evaluate the worth of the bond, it should lead to the same end result for me. That is what we are calling as arbitrage free. Otherwise, it creates opportunities where one will try to take an advantage of the differences that are coming because of the pricing or the valuation mechanism. So this particular 4.435%, which is that one single discounting rate which is applied to all the cash flows to equate the price to the market price. So when I discount this particular cash flows with 4.435%, if I assume that this is the market price of the bond, so if at all I am using 4.435% as the discount rate for discounting all the cash flows, that particular interest rate is working out as what we call as the bond yield. The bond is yielding me 4.435%, where we talk about that particular discount rate where the present value of all the future cash flows will be equal to the market price. So in this example, if I assume 95.46 is the market price of the bond, then that is what will work out to be the present value. Will be work out 4.435% will work out to be the bond yield, or sometimes people call as yield to maturity of the bond. YTM is a very common name that is applicable to that, right? Now, in the same context, we talk about a few more concepts. One is the par yield. Par yield is nothing but that particular coupon value. Now here we have taken it as 3.5. But what I want is that particular coupon value which will make this particular sum equal to the face value itself, which means probably instead of see if I take, let's say here, instead of 3.5 I make it 4. Now this present value has become 97.69. Rather than that I make it 5. It has gone to 102. If I make this 4.5, almost 99.92, 4.52, 100. Now what I am more interested in is what should be this particular coupon rate, which when I discount them using the spot rates will give me the present value which is equivalent to that par value itself. That particular coupon which will make the present value of the future cash flows equal to par value, and that too when I discount it using the spot rates. That kind of a yield is what we call as par yield, as we have seen in this particular example. So these are some of the different kinds of interest. Even that is also a kind of an interest rate. So in this case we are talking about around 4.52% being the par yield in this particular situation. Now the next important thing is, how do I typically determine these zero coupon bond rates? In the earlier example, I have directly taken the zero coupon bond rates like this. I have taken the rate, just some numbers I have typed in. But in reality, how are these numbers determined? One, there is a mechanism called treasury strips, generally sold by the dealers. It's nothing but, okay, if I have, let's assume there is one 3-year treasury bond. Now what are the cash flows with this 3-year treasury bond at the end of 1 year, 2 years, 3 years? There is a coupon that is paid at the end of 1 year. There is a coupon at the end of 2 years. There is a principal plus coupon at the end of 3 years. Now, a dealer who has purchased this particular bond, he can get into strip this bond and sell them as different instruments. So out of this he creates 4 instruments matching the cash flows of the bond. So he'll sell it as one 1 year strip which will pay C on maturity, one 2-year strip which will pay C on maturity, one 3-year strip which will pay C on maturity, and one 3-year strip which will pay P on maturity. So this one single bond is getting stripped into 4 different individual zero coupon bonds. Now these become zero coupon bonds because no intermediate payments, because it is, if I see, look at this one single, at the end of 2 years there is a C that is being paid. Nothing is paid intermediately. If I am looking at it, at the end of 3 years, there is a C that is getting paid. Nothing is paid intermediately. So, a coupon bond, a traditional treasury bond, a coupon based bond, is getting converted into 4 zero coupon, or probably if it is a N-year bond with annual payments, annual coupon payments, then it could be split into n plus 1 zero coupon bonds, n for the coupons and 1 for the principal. So it is, if it is split into, if it is stripped into these kind, they are called as treasury strips. Now observing the interest rates that are associated with each of the strips, I can take the zero rate straightforward, or if that is not the case, then I can refer to very highly liquid treasury bonds that are sold in the market, that are trading in the market at different maturities. For different maturities, I can take the different bonds and bills that are getting traded in the market, and based on their cash flows, I can very well work out the zero coupon bond rates. Straightforward, we'll take one example. Let's say I have some of the more common zero coupon bond rates. One is, okay, I'll talk about the maturity of these bonds. Let's say there is one bond that is available, treasury bill with a 6 months maturity, right? The face value of all of them, let's say, is 100. The current price that is available for this bond, for this treasury bill, I'll take it as 94. Right, there is one more treasury bill that is available for a 12-month period, and I'm assuming that the price of it is somewhere around some 89. There is a 1.5 year bond, 1.5 year maturity coupon. Okay, in this case, at least in case of treasury bills, they are zero coupon bonds, whereas in case of 1.5 year bond, I'm talking about a coupon of 4 is paid every 6 months. Right, all, let's assume all the coupon payments are semi-annual, so there is a coupon that is paid of $4 every 6 months, and let's say the current price of it is 94.84. So all the face values are 100 only. Similarly, there is one highly liquid 2-year bond that is available, which is paying a coupon of 5 every 6 months, and currently let's say it is selling at 97.12. Now from here, how do I compute a 0.5 year spot rate, a 1 year spot rate, 1.5 years and 2 year spot rate? This is where what I go ahead with is, initially we'll start with the first one. Okay, it's a 6-month treasury bill, no coupon. So the cash flows that are there with that particular treasury bill are 100 at the end of 6 months. That's it. So the price is equal to the present value of the future cash flows. So some are, I'm talking about with 0.5 years. So based on this, I can very well compute E per 0.5 R is working out to 100 by 94, and 0.5 R will become the logarithm of 100 by 94, and probably R will become twice of logarithm of 100 by 94. So from here I can find out this spot rate twice of logarithm of 100 by 94. This is what will become 12.37% is becoming a 0.5 year spot rate, half year spot. Now the same logic, if I go for 1 year, even this is a treasury bill, so the only payment, only cash flow that is coming is at the end of 1 year, right? So 100 divided by R 1 is equal to 89. So E per R is coming out to 100 by 89. R will come out as log 100 by 89. So in this case, this is working out to log 100 by 89, giving me 11.65% is the 1 year spot rate in this case. But now the key comes, which is the next. There is a coupon bond that I am taking. 100 is the face value of that, 4 is the coupon, 1.5 maturity, 94 is the price. So how do I write it? The theoretical price 94.84 should be equal to, what are the cash flows? 4 at the end of 6 months. So I'll take 6 months spot rate. We have got the 6 months spot rate. 6 months spot rate into 0.5. Another 4 e to the power of 1 year spot rate into 1, plus another 4, and even a face value would be paid because that is the maturity period, 1.5 year. So R3 multiplied by 1.5. I know R1 and R2 already, so I can first compute R1 and R2, or I can compute the cash flows based on R1 and R2. So the first one I'll take it as 4 divided by e to the power of 4 divided by e to the power of R. This is the 6-month rate multiplied by 6 months. So that is the present value. And the other present value is R divided by e to the power of this multiplied by 1. So these are the present values of the first two. So I subtract those two from 94.84. So which is working out to 94.84 minus this minus this. So overall 87.52. This transformed equation is becoming 87.52 equal to 105 divided by e to the power of R3 times 1.5. So from here I can very well make out e power 1.5 R3 is equal to 104 by 87.52. So R3 will work out to 1 by 1.5 times log 104 by 87.52. So this will get operated out for R3, which will work out as 1 by 1.5 times logarithm of 104 divided by 87.52. 104, this is how the 104 is coming out, and I divide this by 87.52. So this is giving me that yes, the 1.5 year spot rate is working out to somewhere around 11.5%. Now the same logic I can take for the 2-year one. Now I hope you are comfortable in solving this. 97.12 is equal to 5 by e power r1 into 0.5 plus 5 divided by e power r2 into 1 plus 5 divided by e power r3 into 1.5 plus 105 divided by e power r4 into 2. So these three values are already known now. So these three values, if I am trying to compute, 5 divided by e to the power of r1 into 0.5, 5 divided by e to the power 5 divided by e to the power of r2 into 1. Then we have 5 divided by e to the power of r3 into 1.5. Now because of this, we can very well take all these three and adjust the equation. So I'll from 97.12 I subtract all these three pieces, which will create 83.76. Now this is working out to 83.76 equal to 105 divided by e power 2 r4. Now the same logic, so r4 will come out as 1 by 2 times r4 will come out as 1 by 2, which is 0.5 times logarithm of 105, which comes out as 100 plus 5, 105 divided by 83.76. So in this case, this is working out to 11.76 3% almost. So what we are able to see in this case is these are the treasury rates for zero point 0.5 years, 1 year, 1.5 year and 2 years. This is how we typically find out the treasury, the zero coupon bond rates, which are the spot rates from the most commonly available bonds, right? Using the various treasury bonds and the treasury bills, we try to do a one by one kind of analysis, and based on that, we try to extract the spot rates. This kind of a method where we are trying to extract the spot rates from the bond prices is what we call as bootstrapping method, right? We can compute the spot rates, and after that we can, once the spot rates are there with us, we can very well use them to find the bond rates for any other kind of a bond. And now if I try to plot a small graph for each of these, right, I try to plot a small line chart denoting each of these, or probably let me take, let me plot a scatter plot, right, probably with the line if I want to take. So this is how the spot rates are being seen, and this kind of a graph where we are trying to plot the spot rates for different time periods is what we call as the spot rate curve or the zero curve. Theoretical zero curve or theoretical spot rate curve is what we are using. So this we can use for predicting, probably if I want for 0.75, it's as good as identifying compared to 0.75 what is the plot. So if at all I'm looking at 0.75 years of maturity, from this theoretical spot rate curve, I should be able to identify what should be the interest rate for 0.75 years maturity and so on. Generally, because we don't have the various coupon bond, various treasury bonds or treasury bills for almost all time periods, what we do is we take the most commonly available and highly liquid bonds. Based on them, we create a theoretical spot rate curve like this, and we do a simple interpolation. Either it could be done from the graph, or probably looking at the gap between the various intervals. I can very well try to find out what is an appropriate interest rate associated with that particular period. The graph is something which can directly give me, let's say I want it for 1.1 to 1.2 years, then probably corresponding to this 1.2, I can find out what is this particular point, let's say 11.6%. I can use it as a spot rate for that 1.2 years kind of an instrument. That's one way we can work out with the spot rates or the zero rates given the bond rates, right? Now from this spot rates we will move towards the forward rates. See, when we define the spot rate, let's say when we define a 2-year spot rate, we said I deposit something today and I get something at the end of 2 years. Then what is that annualized interest rate for this 2-year period? Similarly, when I talk about a 3-year spot rate, I am depositing something now, getting something at the end of 3 years, no intermediate payments. Then what is the annual interest rate that is applicable over this 3-year period? Now, these are the spot rates that are available. Now, what we are talking of is If the 2-year spot rate is something and 3-year spot rate is something, what should be the interest rate between the 2 and 3 years? As of today, what should be the interest rate between the second and the third year? So we are talking about the interest rates in future. We are talking about the interest rates in future based on the current zero coupon bond rates. So here in this example we got a 0.5 year zero coupon bond, or probably 1 year zero coupon bond is 11.65%. 1.5 year zero coupon bond is 11.5%. Now if I want to know what is the interest rate between 1 and 1.5 year, not as of today, but between 1 year from now and 1.5 year from now, what is going to be the interest rate? That is what we are trying to arrive at using this forward rate. Now, the forward rate, the way we can determine the forward rates is a straightforward formula: R2T2 minus R1T1 divided by T2 minus T1. This is a straightforward formula. So, if I want to know what is the forward rate given the spot rates, if I want to know what is the forward rate between zero point 0.5 and 1 year here, I'll take it as R2 T2 maturity period minus R1 T1 divided by T2 minus T1, 1 minus 0.5. T2 is this minus 0.5. So the 1 year, the forward rate between 0.5 and 1 year is going to be somewhere around 10.93%. Similarly, if I want between 1 and 1.5, what is going to be the interest rate? The same logic. R2 T2 minus R1 T1 divided by T2 minus T1, T2 minus T1. So here it is going to be 11.19% or 11.2%, and here if I want to know, again the same logic, R2 T2 minus R1 T1 divided by T2 minus T1. So here it is working out to somewhere around 10.69%. So this is working out to somewhere around 10.69%. So what we are typically talking of is, from the spot rates I can convert into forward rates, or from the forward rates I can find out the spot rates. So because of this interconvertibility and this forward rate, as of today it finds that probably from between 1 and 1.5 year the interest rate is going to be 11.2%. Now in reality the interest rate may be 11.2%, maybe higher than 11.2 or maybe lower than 11.2% when I reach that particular point in time. So if at all I want to freeze that particular interest rate probably at 11.2, I can even get into some kind of trading instruments called forward rate agreement. I can try to do a trading in the over the counter market. There are FRAs that are traded quite comfortably in there are FRAs that are traded quite comfortably in the over the counter market, wherein I can get into an agreement with the counterparty fixing the interest rate to be somewhere around 11.2%. Let's say I can enter into that agreement either as a borrower or a lender. If I am if I am entering as a borrower, it means that I would be borrowing for 6 months between 1 and 1.5 year at 11.2%. So if the market rate probably after 1 year it is going to be 11.5%, then this borrower is going to get a profit of 0.3% because he is still able to borrow on the loan at 11.2%, whereas the market rate is 11.5. Rather, if the market rate has gone down to 10.9%, at that point the spot rate is 10.9%, then obviously he is facing a loss of 0.3%. So this kind of forward agreements are typically there, which are floated in the over the counter market. So we can very well assess based on this interest rate. Let's say in the same example, A and B have got into an agreement. A says that he is ready to borrow from B 1 year later some $1,000 for 6 months. After 1 year, right? For 6 months after 1 year, he is going to borrow and at 11.2. So which means okay, this is today, this is after 1 year, and this is after 1.5 year. Now the interest rate between 11 between 1 and 1.5 year is going to be 11.2 as per our assessment of the forward rate. So here the interest rate is going to be 11.2%. Now a person has taken a loan, is the person who got into an agreement, he wants to take a loan here for $1,000 for a 6 month period, means the repayment of the loan is going to be on this particular date. Let's assume that on this day actually the interest rate has become 11.5%. Then this person who has got into an FRA, he got a benefit of 0.3%. This 0.3% is for 1 year, but his borrowing is only for 6 months. So he has got 0.15% for that 6 month period and 0.15% on the 1,000. So he is getting a $15 benefit. Here, when he is paying the loan, he is getting a benefit of some $15. So this $15, I can take them to the present value as on this date when the interest rate is 11.5%. I can take it as e to the power of 11.5% into 0.5. This is what is giving me the value of this FRA, the value of this forward rate agreement. Or at the same time, if I want to know what is the benefit the party has got because of getting into the forward rate agreement, in this case I can say $15 is the benefit that the party has obtained by getting into forward rate, because he is able to freeze the rate at 11.2% irrespective of whatever is the interest rate. But if the on the other side the market rate had gone to 10.9, then there could be a loss of $15 on that same amount when he is actually clearing her payment of the loan. So that's another way the valuations are the finding out the profit or loss coming out of the forward rate agreement can quite comfortably be taken up, right? So these are some of the important aspects associated with the interest rates, understanding the different types of interest rates, and then looking at the concepts of spot rate, the bond yields, the forward rates, and computations corresponding to that. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much. In this session, I'm going to look at two important concepts with respect to the bonds, which are the measures of the interest rate risk. With respect to a bond, they are the prime measures of interest rate risk, which we classify them as duration and convexity. As the word itself is meaning, the duration is on an average what is the time that it takes for an investor of a bond to get all his cash payments back. On an average, what is the time that it is taking the investor of a bond to get his cash payments back? That is what we are calling as a duration. And we are talking about a zero coupon bond, where let's say I'm talking about a 5-year zero coupon bond. Means the person is investing something today, is getting something at the end of 5 years, and no intermediate payments. So which means whatever is the cash flow that he is receiving, it's one single lump sum. So the average duration in case of zero coupon bond is the maturity period itself. So the duration is coming out to 5. But in case of a coupon based bond, it cannot be 5, because some amount is coming on maturity, whereas some amounts which are the coupons are coming probably at the end of 1 year, at the end of 2 years, and something like that. So the average time that it is taking to receive all the payment will be lesser than 5 years itself, right? So that is what is one powerful measure of the interest rate risk. Because the other way the duration gets defined, slowly we'll see that it is nothing but the percentage change in the price of the bond divided by the percentage change in interest rate. Even this kind of a logic also gets applicable for the same concept. Let's get back, but the initial definition of the duration for me is, on an average, what is the time that it is taking for the investor in the bond to get his all the payments comfortably back. For this purpose, I want to take a simple example, a 5-year bond, right? We are talking about a 5-year maturity bond with the coupons. Let's say it's a 5% coupon bond, annual payment of the coupons. So which means payments of 5, 5, 5, 5 and 105 are received over the next 5 years. And let's assume that I can go with the spot rate, or probably I'm taking a yield to maturity here, which is one single rate for the entire period. Let's say I'm taking 6% as the yield to maturity. So in this case, I can find out the present value, this divided by e to the power of 6% times the time period. So this happens to be the present value, and finally these are the present values, and from here I get the value of the bond. The value of the bond is coming out to be the summation of all these things, giving me that 95.03 should be the theoretical price of the bond. Now here we are seeing that 105 is getting after 5 years, 5 is coming after 4 years, 5 is coming after 3 years. Now I want to know what is that approximate or average time period for receiving all these cash flows. Probably 5 is coming after 1 year, 5 is coming after 2 years. So if I want to know what is the duration, which means what is the average time period that is coming out in this process. Now from that perspective, the way we are computing the duration is, we can take the present values. So these are the present values of all the cash flows that are coming up. Express them as a weightage of this. Okay, so for the first thing, before I get into the duration, I will take the weights. The weightage, I'm taking it as this number divided by this number. So there is a 4.9% or some kind of a weightage to all these things, right? So these are the weightages that are applicable. And now what I can do is for the duration computation, I'll take the time multiplied by weight, which is nothing but this weightage. I multiply it with the time to finally arrive at the total summation of all of them. I sum up all and I get this as the duration. So in this case, the duration is approximately 4.53 years. If it had been a zero coupon bond, then the duration is 5 years. Whereas if it had been a coupon based bond, as the coupon payments are lying in this current example, the duration is 4.53 years. Probably the other way to talk about is the risk of this particular bond is more or less similar. The interest rate risk of this particular bond is more or less similar to a zero coupon bond, which is having a maturity of 4.53 years. So both of them carry similar amounts of duration, so similar amounts of interest rate risk. That's one way we can try to link up. And the way this formula came up also, see, on a simple note, if I have to see the price of the bond, it is nothing but all the cash flows C1 e to the power of R1 T1, C2 e to the power of R2 T2. It's going something like this. So even if I am going with one single interest rate mechanism, then it is going with C1 e per RT1, C2 e per RT2, so on. So it is coming out as the summation of, let's say I'm talking of I equal to 1 to n, Ci divided by e to the power of RTI. And whatever is the principal amount, probably is the coupons as well as principal, I am taking them as different cash flows. So the present value of the bond is coming out to something like this. Now if at all I am multiplying this present value, right, if at all I am multiplying this present value with the time period, with the time period and dividing it by the price of the bond, this is what is coming out as the duration. And in this case, it's also looking like if I am taking the derivative of the price of the bond, the first derivative, first differentiation of the price of the bond with respect to with respect to the price, with respect to the interest rate. If I am taking the first derivative of the price of the bond, that is also working out to be the same number. So either I do a multiplication like this, or I take the first derivative of the price. If that is giving me the expression relating to the price of the first derivative with respect to the interest rate, that is also giving me the concept of duration itself, which means either I do a weighted average multiplying it like this, or I can talk about percentage change in price of the bond divided percentage change in price of the bond divided by the percentage change in the interest rate. Now that is the powerful relation that is helping us out in terms of predicting the bond price, predicting the bond price if the interest rates are changing, because this is talking about the duration is nothing but percentage change in the price of the bond divided by the percentage change in the interest rates. So this is what is coming out as the definition of duration, right? Percentage change. Okay, the percentage change is straightforward. So from here we can talk about the percentage change in the price of the bond is coming out as the initial price of the bond multiplied by duration multiplied by percentage change in the interest rate. So if at all I know what is the duration of the particular bond. In this example we got it as 4.53. Let's say the price of this bond, currently we have seen that the price of this bond is 95.03. So in case the interest rate change by 0.25%, right? In case the interest rates change by 0.25%, I can talk about what is the percentage change in the price of the bond. So I'll take it as duration multiplied by price multiplied by 0.25%. So I know that the percentage change in the price of the bond is going to be 1.07%. So I could very well talk about 1.07%. If this interest rate has gone up by 0.25, I'll say that the bond price has come down by 1.07%, saying that it will be down, by around $1. So from 95.03 it will become 94.01. So that's the way, especially for small changes in the interest rates. For small changes in the interest rate, I can directly use this duration relationship to typically arrive at the percentage change in the price of the bond if the interest rate or the yield is changing. So this 0.25%, just as a notation, sometimes we write it as 25 basis points. Basis point is a term which corresponds to 0.01 percentage change, especially if the changes are very minute like this. We quote them in form of basis points, not in the form of percentages. So when someone has said there is a 1 basis point change, then it's as good as saying the percentage change in the interest rate is 0.01%. So apply that 0.01%, we can try to compute whatever is the change in the price of the bond. So this is boiling out. The definition of the duration for me is boiling out here as simple as percentage change in the price of the bond divided by the percentage change in the interest rate. So this is giving me a better kind of a definition, and probably on the other side the number that is coming out is a clear indicator for us, saying that this is the approximate on an average, this is the time that would be taken by the investor to typically recover all the cash flows on the bond that he has typically invested. Now that entire definition and the calculation, whatever we have got with respect to the duration, is under the assumption that the interest rate R is taken on a continuous compounding basis. Now if R is not taken on a continuous compounding, if it is taken on annual compounding, if R is computed on an annual compounding basis, then I can say the same logic. Then if at all I want to find out the percentage change in price, earlier we got the percentage change in price as the original price multiplied by duration multiplied by change in the interest rate. Now if it is based on annual compounding, all I'll do is I'll divide the same by 1 plus R. If it is on half yearly compounding, I'll divide it by 1 plus R by 2. If it is on mthly compounding, I'll divide it by 1 plus R by m. That is what is coming out as a percentage change in price, which means even the duration So the change is coming out with respect to duration. If it is a continuous compounding, I'll take the duration as it is. If it is annual compounding, I'll take the duration as d by 1 plus r. If it is semi-annual, I'll take it as 1d by 1 plus r by 2. If it is monthly compounding, I'll take the duration as d divided by 1 plus r by m. And this kind of a duration that we are getting typically, wherein we are adjusting the duration based on the compounding frequency, is what we are calling as modified duration. So in some cases, if I'm using the first derivative kind of a concept, or if I'm doing a weighted average see here, the weighted average of the present value of the cash flows multiplied with respect to the timing in which I'm getting. Right, the weights are the present values of the cash flows. I am multiplying them with the time periods to finally arrive at the duration. So from that dimension, right, or probably it's as good as saying I take the other way I could have looked at it is I compute the present value for each period, multiply it with the timing. So here I would have taken the present value, multiply it with the time. So these are the numbers, and sum it up and divided it by the price. Even that is the other way I could have looked at this number, divide by the price, which will give me again the duration which I have got the other way also. Now the modified duration is under the concept, once I know the compounding frequency that is coming up, I'll get a modified duration value accordingly by dividing the duration either by 1 plus r or 1 plus r by 2 or any other appropriate number. And now on the other context, I can talk about the duration for a portfolio, especially if I am having, let's say, three bonds, the duration for the first one being 7, the second one being 4, and the third one being 3.7. Now all we are saying is depending on the weightage in each of these bonds, which the weights are determined again based on the present value. So find out the weightage of investment in each of these bonds, find the weighted average with respect to their durations, and we can talk about as a portfolio duration. Of course, all these things will really work when the interest rates. So here, if at all I want to see how my bond portfolio is getting impacted in this case, I can change the interest rate, let's say by 0.25%, and now I know the portfolio duration here, I know the portfolio value. I can very well try to compute what is the change in the portfolio value if the duration or if the interest rates are increased or decreased by 0.25%. But this entire calculation is valid only under the assumption that this interest rate of 0.25% will impact all these bonds in the same manner, which means it's a parallel shift. For 7 years, 5 years, all the interest rates will be shifted by 0.25%. That is what we call as the parallel shift. Only when I assume that there is a parallel shift, we can use this kind of mechanism to typically find out the duration of the portfolio. And why do we really need to look at the duration? Any company or any financial institution, they would try to do the portfolio duration for all their assets, and also they do the portfolio duration for all their liabilities. They will try to match the portfolio duration of the assets with the portfolio duration of the liabilities. So that will give them a kind of a flexibility that if the interest rates change slightly, change a little, like 0.25%, 0.1%, 0.20 basis point, 10 basis points, if the interest rates are going to change a little, and that to have a parallel shift means all the interest rates are getting shifted by that small change, then they could very well shield their protect themselves against any kind of fluctuations to the interest rates, or it will definitely protect them from making any kind of losses because of interest rate changes, that too in small amounts and that too with a parallel shift. But if the interest rate changes are going to be larger amounts, we see that the duration mechanism will not work, because traditionally, if we see the interest rates here and the price of the bond here, the price to yield curve is actually a kind of a curve, and the slope, the first derivative of that curve, which is what is the duration. So what we see is duration is the tangent to this curve, and what we are observing is between this small area, probably the duration and the price curve are more or less the same. So duration is a better predictor of the price, especially in that small region. If the interest rates fluctuate in the small region, then duration is a better predictor of the price. But if the interest rates are changing drastically, let's say from here the interest rate came here, probably I can use duration, because duration and the price are more or less the same, the curve and the straight line, the tangent. But if the interest rate comes here, the duration is predicting this as your price, whereas the actual price is this much. Because of the curvature that is coming up, we can't use duration as a better estimator of the price or change in price of the bond, especially if the interest rate changes are quite larger. And where the interest rate changes are quite larger, we bring in the concept of convexity, which is a measure of the curvature that is present in the curve. And the simple way is we take that as the second derivative of the price yield function. So the second derivative for us is a straightforward stuff here itself. Instead of PV multiplied by T, I would have multiplied PV multiplied by T square. So I will take this PV multiplied with T square, and across I am going to take this number, and finally I am going to add them up, and this time I would divide this number by the price, saying that this is the convexity. The convexity is somewhere around 21.75 units. So the convexity is somewhere around 21.75, which is coming out as the second derivative of the stuff. So probably again expressing the same in this particular manner, the convexity is nothing but, so if I am earlier when we had tried to find out the price of the bond, we said it is the change in price. We took the original price, multiplied it by the duration, and then multiplied by the change in the interest rate. But now when I am bringing in the percentage change in price, I'll take like this, minus the duration times the percentage change in the interest rate, plus half convexity times the percentage change in the interest rate squared. This is the kind of a formula that is going to give me the percentage change in the price with respect the percentage change in price if I am considering both the duration as well as the convexity. So the convexity is going to be very high if there are more and more even payments and long period of time. More spread out payments over a long period of time, we see that the convexity is going to be much higher. The convexity is going to be much lower if generally the payments are concentrated at a point in time. around a particular point in time, if majority of the payments are coming up, especially like in case of a zero coupon bond, all the payments are getting concentrated towards the maturity date. So when I am having a large proportions of the payments happening at one single point in time, we see the convexities will be much lower. Whereas if the payments are happening evenly at different points in time, we see that the convexities are going to be much higher. And from a financial institutions perspective, again, just like the way we talked about the duration of the assets should match with the duration of the liabilities, the companies would like to match the convexity of the assets with the convexity of the liabilities also. These two steps, when they are doing, the simplicity that they were going to derive out of it is, even if there are small shifts in the interest rate or large shifts in the interest rates, as long as the shifts are parallel, means an increase of 0.5% in the interest rate means even a 1 year interest rate will increase by 0.5%, a 5 year interest rate will increase by 0.5%, and a 25-year interest rate also will increase by 0.5%. If that is the kind of a parallel shift that is coming across, a duration matching as well as convexity matching will definitely provide a complete shield for a small change as well as a larger change in the interest rates, right? So that is what I wanted to talk about, the two powerful measures of interest rate risk, the duration and the convexity. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.